Have you ever thought about investing in gold, but need to know about how the prices fluctuate? Are you unaware of the economic booms and financial crises that significantly shape the value of gold? Gold has served as the world's economic pulse throughout history, and it does so now as well while reacting to inflation, interest rates, and geopolitical tensions. So, do you want to learn about these fluctuating elements and how to leverage them? Well, if you do, then let's go through the impact of global economic conditions on gold prices, so that you can understand the hidden patterns and strategic moves that can help you navigate the complex world of gold investment. Gold holds a significant value as a fundamental asset throughout human history, not just because of its shiny allure, but because of its rarity and intrinsic worth. It has served as a symbol of wealth and store of values for thousands of years, revered by cultures and economies worldwide. Even in present-day financial markets, gold has held its value as a worthy investment because it is deemed as one of the most reliable means of preserving your wealth, serving as a cushion during economic uncertainties. As the cost of living rises, the price of gold typically increases, preserving the purchasing power of those who hold it. This is because gold is priced in dollars, and as inflation erodes the value of the dollar, gold prices tend to rise in response. While this may sound simple, it's not always the case, as gold prices tend to fluctuate up and down, and the factors are necessary to be known by investors, economists, and policymakers alike. So the first factor that fluctuates the gold prices is the one that drives many investors towards gold in the first place, and that is inflation. It is quite obvious that gold has always been regarded as an economic hedge during times of economic turmoil, and since it is a well-known solid fact, many investors, either novices or veterans, turn to gold whenever times of inflation are predicted. Also, gold has low correlation with most other asset classes, such as stocks and bonds, allowing it to perform well when traditional investments falter, balancing the overall risk and return profile of an investment portfolio. Its liquidity also allows it to be quickly converted into cash without significant loss of value, making it an excellent option for meeting emergency expenses or capitalizing on investment opportunities without delay. Consequently, when all of the investors run towards gold to preserve their wealth, its prices increase exponentially, driven by its significant demand. The reason for such price hikes is that, unlike fiat currencies which can be printed at will, considering the demand, gold can only be obtained through mining, and cannot be produced through artificial means. Since it is a rare metal found in nature, its price shoots off the charts as the demand increases. So when inflation increases, the demand and price of gold also increase respectively. Remember the inflation hikes of the 70s, when the average federal funds rate skyrocketed from 8.298% to 13.82%, as per the reports of the Federal Reserve Bank of St. Louis. And during this time, the price of gold rose from $35 a share to a staggering $850 a share, according to NASDAQ. On the other hand, interest rates also play a crucial role in setting up gold prices, as their decline reduces the opportunity cost of holding gold, which makes it even more alluring for investors. Conversely, the increasing interest rates drive away the investors towards other interest-bearing assets, reducing their demand and price overall. Well, you might think that currency fluctuations overlap with inflation, but that's not always the case. Since gold has been tied down to the worth of US dollars globally, currency fluctuations in exchange rates might become one of the factors controlling gold prices. The inverse correlation of gold with US dollars is one of the most well-known relationships among financial experts worldwide. Since the dollar is the world's primary reserve currency, its fluctuation moves the prices of gold on a national scale. A weaker dollar diminishes the price of gold, making it cheaper for investors holding stronger currencies, while a stronger dollar boosts the value of gold, making it harder for investors with weaker currencies to buy. Well, if we're talking about currency fluctuations and inflations, why not bring up one of the most important factors that trigger economic uncertainties? And that is the geopolitical strain. It's not as simple as it sounds, as some minor scuffles or tensions do not even make a scratch upon the financial stability. Financial instability is triggered by a chain of reactions, driven by such geopolitical tensions, driving the affectees to seek haven in gold. Well, there are several reasons why geopolitical tensions affect the prices of gold, starting with the risk of economic bloodbath and its impact on financial markets all across the globe. As a result, they seek refuge in assets like gold, which are historically perceived as safe investments. When countries are thrown into conflicts and wars, their currency takes a significant hit, as more printing causes currency devaluation or depreciation. Consequently, the investors, being aware of the assets tied with the currency, run towards gold to preserve their wealth for harder times. And since gold is a highly liquid asset, it can be easily bought and sold during times of crisis. Additionally, the disruption of supply chains causes a risk of inflation, which makes gold the only option, not only for individuals but also for the central banks to turn towards. Consequently, the process of gold stocking starts at a much higher level to retain financial stability and independence on foreign currencies, which triggers a massive demand for gold, thus resulting in a significant price hike. Meanwhile, trade relations and agreements between major economies can affect gold prices as well, like trade tensions between the US and China, which can lead to economic instability and uncertainty, prompting investors to turn to gold. Additionally, tariffs and trade barriers can disrupt global markets, further influencing gold demand and prices. However, the severity of these price fluctuations depends upon the severity of geopolitical tensions, as minor scuffles or short-term economic sanctions result in a short-lived price hike, while long-term political tensions, which escalate to much worse conditions, can result in a much longer price hike. One such example of this can be the Gulf War period during 1990 to 1991, which triggered a short-lived price hike, and the current Russia-Ukraine war, which resulted in a near-record hike in 2022. Now, before we proceed, if you want to know more about gold and its relation with economic factors, then like our video and subscribe to our channel for more informative content about gold and its investments. The monetary policies of economic giants like the United States, China, and the Eurozone have a significant impact on gold prices, like quantitative easing measures, which demand the large-scale purchasing of gold by central banks, boosting the money supply and prices of gold. Conversely, tight monetary policies imply a rapid decline in gold prices. Along with these monetary policies are some key economic indicators providing insights into the health of the global economy, like GDP growth rates, employment figures, and manufacturing indices. If these indicators show a strong economic performance, it provides a sense of ease among the investors who then go for other investing options, which reduces the demand of gold, and the opposite happens when these indicators show a risk in currency devolution. Moreover, the volatility in the stock markets also correlates with the increase in gold prices, as investors seek to avoid financial risks. So in the end, no matter what the collective impact on gold is, benefit or loss majorly depends on the strategies you apply as an investor. While there is uncertainty regarding some of the factors, it is beneficial for an investor to research and analyze the global market trend, especially during times of economic turmoil. To have a grasp of the global market, one must understand the relationship between currency and gold prices, as well as political factors. It is the research and analysis that empowers the investors to capitalize on the advantage gold offers during times of currency fluctuations, inflation, and political tensions. As we conclude this video, remember that gold is undoubtedly a perfect investment, if done at the right times. To capitalize on this wonderful investment, you have to be well known about the important factors that operate it, and how you can play with minimum risk to yield a maximum advantage.